Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Welcome. Today, we will conduct a rigorous examination of the foundational principles of managerial cost accounting. Our analysis is structured into 5 distinct sections. We'll begin with the anatomy of manufacturing costs, then move to understanding cost behavior, analyzing mixed costs, how these costs appear on financial statements, and we'll conclude with the cost of goods manufactured. We begin by dissecting the fundamental classifications of costs incurred in the manufacturing process. Before we can classify costs, we must define a cost object. Simply put, this is anything for which we are calculating a cost. Throughout this explainer, our cost object will be a single robotic arm produced by the hypothetical firm Helios Robotics. Now, this table clearly delineates the 3 core manufacturing cost classifications. First, we have direct materials. These are the raw materials that are physically and conveniently traced to the finished product. For Helios, that's the high-tensile steel and microprocessors. Second is direct labor, which is the work of factory employees directly associated with building the product, like the wages for an assembly line technician. And finally, manufacturing overhead encompasses all other indirect manufacturing costs, things like factory rent or the supervisor's salary, which are necessary for production but not traceable to a single unit. It is imperative to distinguish between product costs and period costs, as they are treated very differently from an accounting perspective. Product costs include all manufacturing costs, direct materials, direct labor, and overhead. They are considered an asset and are attached to the inventory. They only become an expense, known as the cost of goods sold, when the product is actually sold. Period costs, on the other hand, are non-manufacturing costs, like selling and administrative expenses. They are expensed in the period in which they are incurred. Let's now move to our next section and see how these costs behave as the volume of activity, such as the number of robotic arms produced, changes. Observe how total variable costs, such as the direct materials for Helios Robotics, increase in direct proportion to production volume. At 100 units, the cost is $10,000. At 200 units, it's $20,000. The relationship is perfectly linear. In contrast, the variable cost per unit remains constant regardless of the activity level. Each robotic arm requires the same amount of materials, so the cost per unit is consistently $100, whether 100 or 300 arms are produced. This chart brilliantly illustrates the nature of total fixed costs. Costs, such as the factory's annual insurance premium, do not change with production volume, at least within a certain range. The total remains a constant $50,000. Consequently, the fixed cost per unit varies inversely with activity. As Helios produces more arms, that fixed cost is spread over more units, which reduces the cost per arm. This phenomenon is, of course, the principle behind economies of scale. A crucial point is that these linear cost behaviors hold true only within the relevant range of production. This is the range of activity over which a company expects to operate and where these assumptions are valid. Beyond this range, the cost structure may change. We now address the challenge of mixed costs. These are costs which possess both fixed and variable characteristics, such as a factory's utility bill, and they require a specific analytical approach. To analyze mixed costs, we can employ the high-low method. This is a procedure to separate the cost components by using the 2 extreme points of activity from a given dataset. Let's consider this sample data from Helios Robotics. We will use the high point of activity in March and the low point of activity in May to execute our calculation. Applying the formula, we take the change in cost, $17,000 minus $10,000, and divide it by the change in activity, 3,500 minus 1,500 units. This determines the variable component of the utility cost to be $3.50 per robotic arm. Now, by subtracting the total variable cost at the high activity level, which is $3.50 times 3,500 units, from the total cost of $17,000, we can isolate the total fixed cost component. This comes to $4,750 per month. Let us now examine how these analyzed costs are formally presented in a manufacturer's key financial statements. Unlike a merchandiser, a manufacturing firm must manage and report on 3 categories of inventory, reflecting the stages of the production cycle. These are raw materials for materials not yet in production, work in process for units started but not yet completed, and finished goods for completed goods ready for sale. The primary distinction in the income statement is the cost of goods sold section. You'll see that a manufacturer adds the cost of goods manufactured instead of the cost of goods purchased that a merchandising company would use. This leads us to the culminating calculation, determining the total cost of all goods completed during the period, as detailed in a specific schedule. Conceptually, the cost of goods manufactured is calculated by taking the cost of units we began with in work-in-process inventory, adding all the current production costs for the period, and then subtracting the cost of any units that remain unfinished at the end of the period. This schedule provides a detailed breakdown. We begin with our work-in-process inventory of $15,000. We then calculate total manufacturing costs for the period, summing the direct materials used, the direct labor, and manufacturing overhead to get $267,000. Adding that to our beginning work in process gives us the total cost of work in process. Finally, we subtract the value of the ending work in process inventory, leaving us with the final cost of goods manufactured, $264,000. This detailed understanding of cost structure is not merely an accounting exercise. It is a critical tool for strategic management. This raises a significant question for consideration. How might this detailed knowledge influence a manager's decision to accept a special, one-time order at a discounted price? That is where the practical application of these concepts truly comes to life.